You've probably seen all the headlines, right? Empty office towers, ghost towns in our downtown cores, this so-called commercial real estate apocalypse. But here's the thing. That is only one small part of a much, much bigger story. The truth is, the real estate market is totally fractured. You've got massive risks in some areas and just incredible opportunities in others. So let's pull back that curtain and figure out where the real money is actually going.
And yeah, it all really does start here with the most obvious piece of the crisis. I mean, the pandemic didn't just send us all to work from home. It fundamentally shattered the business model for countless office buildings. This picture, it really captures that feeling, doesn't it? It's like this quiet crisis just unfolding in plain sight, and it is creating these massive ripple effects that are shaking the financial system right down to its core. 17.7%. Just let that number sink in. That's the national office vacancy rate. So nearly 1 out of every 5 offices in the entire country is just sitting empty. Now, this isn't just some boring statistic. This is a direct measure of income that has just evaporated for landlords, and it's putting a mountain of pressure on the banks that lent them all that money. This number is really just the symptom of a much, much deeper problem. Okay, so to really get to the bottom of all this, we're going to follow the same path a professional would. First, we'll tackle the problem everyone sees, the office apocalypse. Then, we're going to uncover this massive wall of debt that's hiding just behind it. From there, we'll learn to think like a pro by, decoding their language. We'll see why not all real estate is created equal, and finally, we are going to crack open the professional's playbook to see exactly how they operate in a market this crazy. So let's start with the story that everybody thinks they know, but we're going to look a little bit deeper. The collapse of office space is way more than just a real estate story. Honestly, it's a symbol of this huge economic and cultural shift. And there is no better example of this than the insane rise and fall of WeWork. The whole WeWork saga is it's a perfect storm. Just a few years back, it was this tech darling, valued at an absolutely insane $47 billion. Their model was super simple. Sign long-term leases on office space, then turn around and rent it out on a short-term basis. Well, when the market turned, that model didn't just bend, it completely shattered. The company went public in 2021 for just $9 billion. We're talking an 80% haircut. Now, it's drowning in $19 billion of liabilities. And here's the kicker. WeWork doesn't even own these buildings. It's just a tenant. But because it's one of the largest private tenants in the entire world, its problem sends shockwaves through the market, pushing that 17.7% vacancy rate even higher. See empty offices? That's the problem you can't see. But the problem you can't see is way, way bigger. We need to talk about debt, specifically this gigantic wall of debt that's about to come due. And it's threatening to turn this office crisis into a full-blown financial crisis. This is the number that is keeping bankers and property owners wide awake at night. $1.8 trillion. Between 2025 and 2026, that is how much commercial real estate debt is maturing. This isn't just some abstract number. This represents thousands upon thousands of loans on thousands of properties that all need to be refinanced in a world that looks absolutely nothing like the one they were created in. And this slide right here, it perfectly explains the heart of the problem. Investors call it the refinancing gap. Just think about it for a second. A loan you took out in 2020, well, that was based on basically zero interest rates and property values at their absolute peak. Your building was full, rent was coming in, money was cheap. Now, let's fast forward to 2025. That same owner has to go get a new loan. But now, interest rates are 5 or 6 times higher. And oh, by the way, their property is worth a whole lot less and probably has vacancies. The new loan is not going to be big enough to pay off the old one. This creates a massive shortfall. Owners are going to have to come up with huge amounts of cash out of pocket, or they're just going to face foreclosure. This is the ticking time bomb. Okay, so that's the crisis. But to really understand how the pros find opportunities inside a crisis like this one, you have to learn to speak their language. They don't value property based on feelings or what their neighbor's house just sold for. No. They use very specific financial metrics to figure out what an income-producing property is actually worth. It all kicks off with something called net operating income, or just NOI. This is basically the lifeblood of a property. You take all the income it makes, so rent, parking fees, laundry, you name it, and you subtract all the operating expenses. Taxes, insurance, maintenance, management fees, whatever is left over before you pay the mortgage, that's your NOI. It's the pure, unadulterated profit that the asset itself produces. You can think of it like a business's operating profit before it's paid back any of its loans. It just tells you how healthy the asset really is on its own. So how does that NOI number connect to what a property is actually worth? Well, that happens through something called the capitalization rate, or for short, the cap rate. The cap rate is simply the NOI divided by the property's value. It's telling you the annual return you'd get if you bought the place with all cash. For all you folks from the stock world, it's a lot like an EV to EBITDA ratio. A low cap rate means you're paying a high price. A high cap rate means you're getting it for a lower price. It is the single most important metric for comparing different properties. And this quote just makes the whole concept crystal clear. Imagine you buy a property with a 10% cap rate. Then maybe interest rates fall, the market gets hot, and suddenly investors are willing to accept a lower return. The cap rate for similar properties compresses down to 5%. Now here's the magic. Even if your NOI, the actual profit your building is making, didn't change by a single dollar, the value of your property just doubled. This is exactly how sophisticated investors made absolute fortunes when interest rates were low. And the danger now, you guessed it. Cap rates are expanding because rates are rising, which does the exact opposite to a property's value. All right, so now that we've got the lingo down, it is so important to realize that the real estate market is not just one thing. It's really a whole universe of different asset classes, and each one has its own economy, its own customers, and its own unique set of risks. The forces that are absolutely crushing the office market are just not the same ones affecting warehouses or apartment buildings. Let's just break this down with the chart here. You can see it clear as day. While the commercial office sector is in a full-blown crisis, thanks to remote work, you can look right over here at the industrial sector, and it's booming, all thanks to e-commerce and this big push to bring supply chains back home. Multifamily, apartments, that's all about population growth and whether people can afford to buy a house. And retail, well, that just depends on how confident we're all feeling about spending money. Smart investors don't just buy real estate. They specialize in a very specific asset class whose future they understand inside and out. So this all leads us to the most important question of all. If the market is this complex and you've got different sectors moving in totally opposite directions, what's the actual game plan? How do the pros not just find value, but how do they actively create it, even when the market is this turbulent? And this is where we get into the real actionable strategies. Look, this isn't about speculating or just hoping the market goes up. The professional's playbook is all about execution. It's about precision, and it's about managing risk at every single stage of the game. One of the most powerful strategies out there is called the BRRRR method. It stands for buy, rehab, rent, refinance, repeat. Now, the absolute key to this whole thing is step 2, rehab. And this isn't just about a new coat of paint. This is about forcing appreciation. By renovating the property and managing it better, you increase its NOI, which means you've literally made it more valuable. So then, when you go to the bank to refinance, the new loan is based on this new, higher value. And if you've done it right, that new loan is big enough to pay off your original loan and give you all of your initial investment back. So you now own a cash-flowing property with zero of your own money left in the deal. That is an infinite return. And that is how portfolios are built. But look, executing these strategies means you have to dodge some serious landmines. First up is operational blindness. Amateurs focus on physical occupancy. Is the building full? Professionals care about economic occupancy. Are the tenants actually paying their rent? Then there's the danger of negative leverage. This happens when your property's cap rate is, say, 5%, but your loan's interest rate is 7%. At that point, every single dollar you borrow is actually losing you money. And finally, you have these super specific legal traps, like the 1031 exchange, which lets you defer taxes. You have a razor-thin 45-day window to identify a new property and 180 days to close. Miss that by even one day, and you could get slammed with a huge, unexpected tax bill. Managing these risks, that's what separates the pros from the people who lose their shirts. So we come all the way back to the beginning, but now we've got a totally new perspective. That $1.8 trillion debt wall, it's coming. And for the over-leveraged owners who bought at the absolute peak, yeah, it's going to be a crisis. It's going to force a lot of them to sell at a loss. But for the disciplined investors who speak the language, who understand the different asset classes, and who use the professional's playbook, that exact same crisis is going to create the buying opportunity of a decade. The only question left is, which one will it be?